All right, let's get right into it. We're going to use a very simple acquisition scenario to really unpack three huge concepts in finance: control, valuation, and the economic reality of goodwill. By the end of this, you'll see just how a single transaction can reveal a company's entire strategy and the big promises it's making to the market.
So here's the central puzzle that we need to solve. A parent company pays $800 for an 80% stake, but somehow the deal implies the subsidiary is worth a total of $980. Now, how does the market justify paying a premium like that, especially when we know the company only has $900 in identifiable net assets? The answer, you'll see, isn't really about accounting tricks. It's all about the economics of control and expectation.
Okay, the first piece of this puzzle is what I like to call the control paradox. Intuitively, you might think, well, 80% ownership means 80% control. It just sounds right, doesn't it? But in corporate finance, control isn't divisible like that. An 80% stake actually gives you 100% control over the entire enterprise.
And the formal accounting definition backs this up completely. You'll notice IFRS 10 doesn't get hung up on a specific percentage. Instead, it focuses on three things: power, exposure to returns, and the ability to use that power to change those returns. An 80% owner has absolute authority on all three of those fronts.
And this right here is the critical economic reality of the whole deal. The parent company now directs not 80% but 100% of the subsidiary's assets. They control how every single dollar of that 900 is put to work to generate returns. That absolute control is precisely why we consolidate 100% of the assets onto the parent's balance sheet. It reflects the real world.
So, we've established the parent has total control. But what exactly are they controlling? What did that $800 investment actually buy them? Well, what they're buying is control over a collection of identifiable net assets. We're talking about things like property, equipment, inventory, stuff you can touch and value. And in this case, all of that has a fair market value of $900. This is the tangible, on-paper value of what the subsidiary has.
This leads us right to the core valuation question. The parent paid $800 for an 80% stake in a business with $900 in assets. You see, that price, it implies something. It's a signal to the market about the total value of this company as a living, breathing, going concern. So, what is that signal?
To answer that, we have to figure out the value of the 20% of the company that the parent didn't buy. This is what we call the non-controlling interest, or NCI, and figuring out its value is an absolutely critical piece of this whole puzzle.
And here's how it all adds up. You have the parent's $800 for their 80% stake. Then you have the implied fair value of that 20% non-controlling interest, which comes out to $180. You put them together, and what do you get? A total implied value for the entire subsidiary of $980.
So now we've got a gap. The market, through this very transaction, is saying the company as a whole is worth $980. But we know the fair value of its identifiable net assets is only $900. There's an 80-point difference staring us in the face. Where does that value actually live?
That difference? That's goodwill. And it is not some accounting fiction or a simple plug to make the balance sheet work. No, it is the price paid for expectation. Think of it as the economic bridge between the tangible assets you can count and the company's total perceived worth.
This 80 is the premium paid for everything that you can't just list on a balance sheet: brand reputation, customer loyalty, secret sauce technology. But most importantly, it's a payment for future potential. It's a bet on the synergies the acquirer believes it can unlock.
This really captures the essence of it perfectly. A company pays for goodwill because they are absolutely convinced they can generate returns with those acquired assets that are far in excess of what those assets could do on their own. They are literally paying today for future synergies. So, the crucial takeaway here is that goodwill is a forward-looking asset. It's the market putting a number on management's strategic vision. It's a cash payment today for a promise of superior performance tomorrow.
So if you're an analyst, how should you be reading this transaction? What are the real practical implications of this newly created goodwill sitting on the balance sheet?
For any smart investor, this goodwill has a few critical implications. First, it blows up the invested capital base, which immediately puts downward pressure on key metrics like return on invested capital. Second, it demands annual impairment testing, which forces management to justify that premium they paid year after year. And third, it's the clearest signal you'll ever get of management's strategic ambitions. It's a bet on future growth that is now quantified for all to see on the balance sheet.
So ultimately, goodwill on the balance sheet isn't just a historical artifact of a deal, it's an active, living measure of ambition.
It's management saying to the market, we paid this premium because we know we can generate serious value with it. For investors, the job is to track that promise and hold them accountable for actually delivering.
And this leaves us with one final and really critical question. We've established that goodwill is the price of an expectation. So what do you do as an investor when the evidence on the ground suggests that expectation is no longer valid? Answering that question? Well, that's the very essence of active investment management.